Hello, and welcome back to the Fintech Takes podcast. Today, I am delighted to be joined by my friend and a fellow Fintech creator, Matthew Goldman. Matthew's been on the podcast before. He is the founder and managing member of Totavi, as well as the author of one of my absolute favorite Fintech newsletters, Cards for the Win, which is a newsletter entirely focused on the credit card space, with sort of a broader lens on payments as well. Matthew has spent his whole career, minus a couple interesting diversions, working in payments, working specifically within the card space, and he's forgotten more about it than I will ever know. So I like to have him come on every once in a while to chat about what he's seen in the credit card space, what's happening in the broader payments landscape, and what it tells us about where the market is going. In today's episode, we have a really fun conversation about the industry's obsession with premium credit cards and how that might actually lead us a little bit astray from building what customers actually need. We talk a little bit about sort of how the costs are and aren't changing in building within fintech, financial services, payments, and specifically card programs. We talk a little bit about asset-backed cards, which is a category that Matthew and I both agree needs to get a lot more attention than it's been getting because it's innovative, fast-growing, compelling to customers, also not without its risks. And so we talk a little bit about that. And then we wrap up by talking about a specific product that both of us lament a little bit and wish perhaps didn't exist, but think is really important to talk about. And we get to end on a bit of a rant. So hang on for the whole episode. As always, it was a delight to chat with Matthew, and I can't wait for you to listen to today's episode. So without further ado, here's my conversation with Matthew Goldman. This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go. All right, Matthew Goldman, thanks for coming back on the podcast.
It's my pleasure to be here.
It's my pleasure to have you. I wanted to have you come back on because I don't know. I feel like if too much time has passed since the last time you and I talked, probably 19,000 different things have happened in the world of revolving credit and credit cards. And feels like a good time to just check in on all of those things. So I have a range of different topics to run through. You ready to go?
I'm ready to go. There's always lots of credit card news.
There is. Keeps you employed. All right. So let's start with an observation I've had, and I want to get your sort of general reaction to it. I do not study the credit card industry obsessively like I used to, but from my outside perspective, one thing that I've definitely noticed, and I think this shows up in at least some of the data that you see about the growth of the credit card space and kind of where the volume is and where the activity is that it's really become a market tilted towards premium cardholders. Most of the products that I see getting launched these days, either by banks or kind of growing, scaling fintech brands, offer very generous rewards. They carry very high annual fees. And it seems just in general like everyone in the market is really chasing after the small but very highly lucrative segment at that sort of premium end of the continuum. So I'm curious, Matthew, if you've seen a similar trend, and if so, why do you think this is becoming such a sort of focus, especially maybe post-pandemic, and especially considering the fact that as our friends at Flagship Advisory Partners wrote about a few months ago, and I'll drop the link to this piece in the show notes, premium products are maybe not as profitable, at least from a kind of pure sort of margin perspective, maybe as folks outside the industry might expect. What do you think is going on here?
Yeah, I think it's absolutely a trend. And I was thinking about this a lot. I don't know if you've read this one. I recently read the Middle Class New Deal by Michelle Dickerson. Yeah. Right. And I mean, I love her phrasing of the lower rich and kind of the bifurcation of the economy versus we talk about upper middle class. And she's like, no, that's lower rich and they have a lot more money. And if you're making as a household, in excess of $250,000 a year, a credit card annual fee is truly a drop in the bucket versus the luxurious feeling. Like people just will do anything for an airport lounge, apparently. I mean, based on the amount people normally travel, you could just pay to go in. Like it's really not that big of a deal. It's like $50 or something. Totally. But people love feeling fancy, right? They love feeling splurged upon. And those users do spend a lot more money. And so even if you're having very rich rewards, like you're just having a lot of volume, right? It's very hard to make cards with $200 limits work because there's just no money flowing through them. I think that one of the things I see, because I've run a couple premium portfolios, is people are always surprised that the lower rich or the folks with Chase Sapphire preferreds or reserves or whatever revolve, but boy do they, right? And it's a smaller percentage, but revolvers are always it's a smaller percentage of users, but a larger percentage of the volume, right? Like if you're revolving, you're stacking up that over time. And so you can make the economics work, even though people think it's counterintuitive that people with money, so to speak, will revolve, but they do. And people still overspend even when they're, high income.
Yeah.
And I think it's also, frankly, like more fun for marketers and product managers and all those things. Like, when I started at Green Dot, one of the things we used to talk about was that this was 20 years ago, and sure, like it was the lowest of the lower middle income, right? People with no bank account, people using a Rite Aid to make a deposit, and we were always discussed like no one who works at Green Dot is our demographic, right? Like by nature, like if our average household income was $30,000 of our cardholders at the time, like we were paying everyone at Green Dot more than that. And so really, I think it's a huge challenge for entrepreneurs and product folks to put themselves in the shoes of these things. And so I think that's also why like brands just love doing it. Like it's more fun. It's like, let's do a cool premium card and let's make it metal and like, or whatever Mercury's new stone thing. Like people they enjoy it. And I think that does have a real impact. It feels easier to do.
Yeah, I think there's absolutely something to that. And I think it's a really smart observation. Like these things are ultimately being done by humans, and humans sort of bring their own preferences and opinions and experiences to that work. And I think maybe the best example of that to me is this might seem a little overly reductive, but like sometimes I look at certain fintech companies and I can just tell that the founder and the early team are all from New York, right? And not just like New York State, but like they live in Midtown, or like they just have this like very specific aesthetic, and then it comes through in the product, right? I'll pick on maybe Built as an example. Like everything about Built is like designed for the urban New York single person who's like in their late 20s and makes, $300,000, $400,000, $500,000 a year. And just like everything about it, all the perks, like, oh, of course, like one of the things you'd want are credits for Uber helicopter rides, because who has time to like go from JFK to Midtown in a car? That's insane. And like, it's a very specific set of benefits that are wrapped around the product. But I think going back to a point you made before, it is interesting that even when you're channeling a relatively narrow slice of consumer psychology, it does seem to have a broader appeal because people want to be fancy, right? Like there's, I know you've spent a lot of time thinking about like the design of cards and, the metal hitting the table and like the sound that makes.
The plink factor.
The plink factor, yes. And I think that like all of those things, even if the person designing it is not designing the product for someone living in Lincoln, Nebraska, that doesn't mean that there's not someone sitting in Lincoln, Nebraska who doesn't want to sort of feel the luxury of that design. And so it is this strange category where it seems to have a broader appeal. And I think your point about like the lower rich is a great example. Like, the growth of the K-shaped economy, like there's a whole bunch of people who are making a lot more money than they used to. And it feels like that's just become sort of almost to this like obsessive or instinctual degree, the place where like if you get permission to launch a new card product, like that's just where your mind goes. That's where you want to compete.
Yeah, I think so kind of a funny aside. I did spend 3 years on what I like to think of my sabbatical from payments. And I worked for AT&T's interactive ad unit. I did do some payment stuff there. That was in the era of ISIS, soft card being started.
Yeah.
But we used to have this joke, like people would come to us startups and, we had hundreds of thousands of small business customers. And they would say, hey, we've got all these people signed up. And we're like, where are they? And they'd be like, San Francisco. Sure. Like, call us when you have some customers in Columbus, Ohio, like, or they'd say like, oh, we have this cool app. And we're like, do you accept faxes? Because that's how stuff happened. I mean, this was, again, 20 years ago, but I think that same point applies here about building products for what versus where your customers are.
Yeah.
And especially in like venture funded companies, everyone's looking for early traction. And so you can build a user base on early traction that is not truly scalable. Like you have a box.
Yeah.
And you're like, I can make this box enormous, but it turns out the box is actually pretty small.
Yeah.
I think about that with like, what is it called? I'm forgetting the super fancy, better than Amex Platinum card.
The Atlas card. Atlas. I was just thinking of that one.
Yeah. Although there's 2 Atlas cards, and one is for subprime and one is for ultra prime. It's amazing. But the ultra prime Atlas card, like you read these articles and people are like, Amex Platinum is too average for me, right?
Totally.
That's basically why people want it.
Totally.
But I think you're right. Like everyone wants. Well, not everyone. Many people want to be fancy. Like people are aspirational. And that's like when I was at Bankrate and, we ran the Points Guy and stuff, which is, of course, the like leading blog in this space.
Sure.
The reality is very few people are using their points and miles to fly first class to Tahiti or whatever. Right. They're actually going to visit grandma in Lincoln, Nebraska. But like it sounds appealing that you could go to Tahiti if you did it right, because like that's your dream and dreaming and hoping and aspiration is a very important part of marketing ultimately.
No, I think that's a great point. And I think the last part I would add to it, and I'd love to get your take on this, is it does feel like, and maybe Built is the best example of this with their transition from Built 1.0 to Built 2.0. It does feel like as a consequence of many, many more companies building in this premium card space, that there is this kind of growing like, I don't know, like bifurcation maybe of different segments within the premium card space. And the observation I have about this is just that, to your point, there's lots of people who sort of see like the points guy, flying first class free to Tahiti and is like, I have to have that card. That sounds amazing. But there's a huge distinction, and there always has been, but it feels like it's getting sharper over time, between people who actually will implement the point guy's actual tracking system for using cards and managing bonuses and rotating points categories and all the things that I know you do, and I know my colleague Kia does, and there's definitely a set of people out there who do, versus people who are sort of drawn to the like luxury, or I guess maybe the vibe of the rewards and the card and the perks, but who use it in a suboptimal fashion. And the reason that I ask about this is because it feels like one of the areas where Built kind of screwed themselves a bit was in really cornering the market on the savvy premium credit card reward users, and not pulling in enough of these sort of aspirational but lazy premium credit card reward users. And when they made the transition from Built 1.0 to Built 2.0, all the sort of savvy players of the game were like, well, you've changed the rules. This doesn't interest me anymore. If Wells Fargo is not going to subsidize, me getting all of these points on my rent, then I'm not really going to use your card anymore. And I think maybe Built underestimated just how much of its sort of New York aesthetic would like translate into like broader appeal for the non-super optimizers out there that are interested in a premium credit card. So like, how do you sort of parse the difference between those two parts of the premium credit card customer segment?
It's it's a couple things. One, it's just been this trend. Like when I first started doing this, I first started getting into credit card points because my very first job was as a traveling consultant for Deloitte. And, you're spending all this money on T&E and your colleagues are teaching you this. And you had to like log into Flyer Talk and be on a forum and people had all these secrets. And you didn't have Reddit or the blogs or these tools to learn. And like, the explosion in the readership of the points guy, right? The explosion in those Reddit, it's like the churning Reddit and the credit card Reddit, like they're just enormous, hundreds of thousands of people in them. With the like AI development, there are more than ever credit card tools. I've been trying to catalog them all now, and it's like every week there's another new one. It feels like tracking some aspect. So at one level, it's become easier to do, and there's more opportunity. And people are more willing to pay annual fees. 10 years ago, almost no one was willing to pay an annual fee on a card. It was sub 25% of cards had them.
Yeah.
But at the same time, like if everyone truly optimized, all the programs would be broke. Like that's just the math. Because what's funny in cards, right, is like the credit card programs don't really set their income. Like the network sets interchange and that's their income.
Yeah.
And so to your point, like they have to make trade-offs. Like Robinhood clearly loses money on every swipe, but believes that they're making money on the whole relationship. So they can do that. And I actually think it probably is working for them. They have a lot of data that they've shared in their public filings that it is. And so if you over optimize, and like Brian Kelly, Mr. The Points guy, was an advisor to Belt.
Yeah.
And he's not a credit card P&L guy, right? He's a credit card marketing guy. And they made a card that, to your point, was like way too easy to game. And it cost them a lot of money. And so it's just not sustainable. And what you're really looking for is a program. And what I advise clients on is like, it's really hard to compete on pure like money, right? Like, and now with Robinhood, like you just can't, right? Like unless you have millions of dollars to throw at people, you have to build rewards programs that are, deeply integrated to what you're doing, and where something about the reward, the affinity to that reward is truly valuable to you and truly unique and causes people to do what I like to think of as like economically irrational decisions, but they're actually rational for them, right? So it's like when I did my wine card, we would make wine available for points, but we would like source these amazing bottles that you couldn't get.
Right.
You could only buy them with points. They were like 100,000 points, for this, whatever, 2002, whatever, right? Like it was really special stuff. And so people started being like, well, I just need points. Like I understand that earning 1 point on your card is not as good as earning, 2 points on this other card. But like I need your points because when this wine bottle comes up, I want to get it because my personal utility, not my economic utility, like my personal enjoyment is so high. And so programs have to be very careful of turning it into pure math. Like that's one of the problems with like pure cashback programs is it's just math, right? And I can use my cash back to like pay my utility bill or offset this thing. And part of what points do is give you the permission to buy things you wouldn't otherwise. Like, would you, if you were a wine aficionado, spend $1,000 on a Harlan Estate bottle? Like maybe not. Would you spend 100,000 points? Like, heck yeah.
Yeah.
Because like they're just points and you can't use them any other way. So you might as well.
Right.
And that's a huge part of the psychology. But I think that like programs have to be very, very careful in their design. And unfortunately, a lot of entrepreneurs, when I first talk to them, they're like, well, I wish programs are more lucrative. And I'm like, well, there's a reason they're not. And you're not like going to outmath Chase. Like you just can't. They're way too good at it. So you have to go somewhere else. And I think that's why we see these kind of, to your point, like these, like, I'm a New Yorker. And like, I literally had people pitch me like the urban hipster card. And I'm like, it's just a Chase Sapphire. We don't need a new one. Like, let's move on.
Yeah, I mean, it's a great point, and it kind of segues to the next thing I wanted to talk about, which is that, you're right. Like, you're not going to outmath Chase. You're not going to outmath Capital One, who's like the OG math nerd on this stuff. Like, you're just not going to outmath these big issuers. And, beyond the sort of like P&L management of a card program, which again, these are like the people working here are like the LeBron James of like card P&L. Like these people are like the best in the world at what they do. You're not going to beat them going head to head. The other thing that I think is really important is the reason they work at Chase or they work at Capital One or they work at American Express or they work at now Robinhood maybe is that these are the organizations that can bring enough other stuff at scale to pay for card programs that are really fun to build and operate and like, build the marketing around, right? Like Robinhood has Robinhood Gold. Robinhood has a incredibly lucrative trading business where if they can just get you to come in and then they can get you to trade prediction markets after you've redeemed your credit card points, they're coming out way ahead, and that can pay for a lot of other stuff. Chase is the same way. They have an entire universal banking business that involves all these other things, and Chase Sapphire Preferred doesn't have to individually be the most incredibly profitable product in the world. And so that's a completely separate game. And occasionally there's some new entrant like Robinhood that earns its way to a seat at the table, can play that game with Chase and Capital One. But it's a very, very rare game that can only be played at massive scale by very smart operators. If we take your alternative path and go, okay, let's design a product where, and I love the framing because it's exactly what I've been thinking about in the age of AI, right? When we have AI agents sort of doing a first pass on all of our decision making in the not too distant future, or for people living in San Francisco, how they live their lives right now, I think the benefit that a business is going to get is entirely going to be driven on, is someone overruling their AI? Like the AI is going to say, hey, optimally what you should do is X, Y, or Z. And you sort of need the customer to go, yes, but for my personal utility, I'm going to overrule that because I want to work with this company because I value this thing. So to me, credit cards and rewards can be a really strong way to sort of solidify that personal utility benefit and create differentiation that like, Chase can go, well, yeah, but you're leaving a ton of money on the table. You should work with us. And like, yes, but I really like this instead. Give me some examples of opportunities or areas or products where you've seen this. And in particular, I'm interested in ones, kind of going back to our earlier point, that might appeal to people who aren't like uber wealthy. Like, do you see any companies that even though, they work in financial services and most of the employees who work at the company make well above the, median American salary, that are doing a good job of kind of honing in on some of these more specific value propositions for perhaps some of these like less well-served segments of the market?
Yeah, I think that what's fun about credit cards to build is that they're a product that people use every day.
Yeah.
Right. They're one of the few financial products that consumers are likely to have more than one of and actually use. Mm-hmm. Right. Like you typically have one deposit account, maybe have one retirement account. So you're willing to do multiple things. And that allows you to pick things off. What the banks have left unguarded, so to speak, this is like real innovator's dilemma, is their niche flank, right? So like Chase is never going to do a program anymore for a small retailer or a small retail chain or a small airline, something like that. And you see this in fintech with companies like Imprint and Cardless building programs for, like Tap Portugal Airlines. Like, I don't know, like if you're not Portuguese, you probably don't care. But if you are Portuguese or you want to go to Portugal, like that's really valuable. Some of these mall retailers like that, you may not think of, especially the coastal folks. Like if you think about like, I don't know, like Ann Taylor Loft or Torrid or, like they have huge credit card portfolios because people who shop there, like that's where they shop. Like they're super fans and buying clothes is important to them and it's part of their identity. And so like, I think that's a great example. And that's the credit card as extension of an existing brand. And it's like traditional affinity, like what MBNA was doing. And I think we're starting to see some interesting stuff in fintech where people are building, these like more nimble program managers, right? Like the Cardless or Imprint that can do a smaller program, can do it profitably, or are focused on a certain thing. There was this company, Mercantile, which was acquired by Onboard Partners. They were doing like business cards. They have like, I don't know, the Dentists Association or something, or podiatrists or whatever. And like, again, like Chase isn't going to do that, but it's like a good business. You can laser focus and serve those people, right? With, unique discounts, unique benefits. I think there's always this tension between the like all-in-one, like, theoretically, everyone could just use Ramp or whatever. Like it's an all-purpose spend platform. But if you're like a contractor, like there's Capital OS is building these like cards for like plumbers and with plumbing software companies, and they're like hyper specific to plumbers. And I love that stuff because there it's like it's again, it's not just the rewards, because saving money on other things is so much more valuable ultimately. And I think people can make that choice Like, this is why people just love Amex, right? Like they know Amex is going to take care of them if there's a dispute.
Right.
And you're more likely to lose $500 on a dispute than to make $500 in rewards in a year. Like, I feel like people kind of, are very risk averse, right? And so that's where I think that there's opportunity for the total package to be available, right? So people have really liked these cards, like, and they haven't all lasted. Like, I liked the Rocket Money card, which was really focused around like subscription management. It was originally the Truebill card that didn't last. I liked, there was some things that died because of the Deserve, failure. Right. There were some things like, like the M1 card, which was like cash back to stock trading. Like, I really think those should have more life, and there should be more of those where they're focused on a particular kind of aggravation or opportunity for a specific user segment. And that's where you can go somewhere and compete, because like the big banks are just way too big to ever want to go after that stuff.
Right. No, I think that's right. I mean, it's the challenge of playing that game at massive scale like Chase and Amex and others do, is that anything that's not that looks like we can't even put one of our product managers on this, because it just doesn't make
it doesn't move the needle.
Right. Yeah. Like, we're not gonna be able to talk about it in our quarterly earnings. And so, like, why are you even bothering me with this? Is kind of the general mindset, it feels like.
That's the other lesson I learned at AT&T. I ran a $700 million P&L, and everyone was like, who cares?
Sure. Right. And yet
like, there's
tons of people out in the market,
company.
who would like love to have access to these other opportunities. I also think, I mean, you mentioned like cards for plumbers and cards for HVAC installers and whatever. I mean, I think the other thing that seems to be happening is, and I think this is probably dovetails with kind of AI and kind of living in the era of like AI coding and whatever, but I just think like the baseline costs to build this stuff have gone down significantly over time. And so now I think the other benefit you have is, like, you can pick out a relatively niche audience that you want to serve. And, one of the things I think we're kind of getting at here is that like niches are all way bigger than you think, especially if you live on the coast and the niche is hiding somewhere in the middle of the country. And you're like, well, how many HVAC installers can there be? Well, it turns out there's a ton, and they make a ton of money, and they're living in the dark ages in terms of the software they're using and the financial products they're using. And it's a massive, massive market. My personal favorite on the vertical SaaS front is there's a company that's built like the sort of premier kind of vertical SaaS operating system for daycares, and it's like, daycares, like, how big a business is that? And it's like, if you have kids or have ever had kids, like,
enormous,
you understand how massive a business, preschool and daycare are. Like, it's insane. And so like, these are great businesses to build. And I think one of the advantages that you have now is you can scale a really good business without having to raise $100 million in funding from VCs, or $50 million from funding from VCs, or maybe even any money from VCs. You can bootstrap stuff.
Yeah, you're still going to need that money if you want to issue a credit card. But
let's talk about that, because that's the thing I'm really interested in pressing on a little bit. Is financial services is the place where there's always like a baseline of you have to have at least some money. What have you seen from like an issuer processor? I know you wrote recently about some sort of consolidation in like the issuer processing space. Like, what have you seen in that area in terms of how it's maybe consolidating, and where costs are maybe coming down versus where it's like, oh yeah, this is still pretty expensive?
I think that issuing cards has become more expensive over the last few years. So like, when I, back in peak BaaS era, like when I worked at Rapdo Payments and we did debit cards, part of our thing was to make it super inexpensive. You could get started for like $5,000. It was like turnkey program management. That was not a great way to make money, it turned out. And a lot of our customers didn't survive. And what I'm seeing now, especially, unfortunately over the last, 12 months, we had a number of startup card programs not make it. Like, I think most kind of famously was Mesa, which seemed to be doing pretty well. And that damaged the space. And the banks, whether you're working with a program manager or directly with a bank is concerned that they're going to put a lot of effort in up front to do diligence and setup, and then the program's not going to go anywhere, because they don't make even when they charge $100,000 setup fees, they don't make any money on that. It's very expensive to do all the compliance work. And so like we're back to like, hey, you need $5 million to put a credit card in market. And it's not that you're going to spend that $5 million. They want to see it on the balance sheet. And that's for operating capital. And then you also need, if you're doing a credit card, lending capital, right? You need a warehouse fund. And those scale really rapidly. Like if you have 2,000 cardholders, you've got $10 million at work at any given moment. And so like you need a lot of stuff to lend. And simultaneously, we have like the private credit crunch, right? For unrelated reasons. I don't think there's any fraud in credit card receivables. It'd be extremely hard to pull off compared to like fake invoices at, auto parts. But like those guys are also skittish. So
yeah.
I have a very, like when I talk to people about building card programs, I have a very funny sales process where basically I say, this is really hard and expensive. Are you sure you want to do it? Like you probably shouldn't. It's like very counterintuitive, but it is, right? You got to go in eyes wide open. You need, $4 or $5 million. You're going to need to raise debt of $10 to $20 million to get started. Yeah. And a bank just isn't going to launch you if you're like, well, I have $1 million, but I'm going to raise more. They're like, okay, call me later.
Totally.
And I think debit cards is lower, but from the bank's perspective, a lot of the risk is the same. They're less concerned about losing money. They're not really lending it themselves. They're concerned about just making a bad choice. And simultaneously, a lot of bigger companies are adding card products like Robinhood, Coinbase, Fold, people are expanding horizontally. And it's much easier to say yes to a company that's like, we already have 2 million users and now we want a credit card. And the bank's like, well, at least they're not going to go out of business. Like, maybe the card will be successful and maybe it won't, but it's not going to die because of lack of funding.
Right. Yeah, I mean, I think that's a really good point. And, it's just the constant kind of challenge. And as you said, like it is a little bit cyclical. And so there'll be these moments of like mania where everyone is like, oh my gosh, like we always invent new terms for it. And so it's like, you have to have been around long enough to be able to kind of recognize like, so like, how is this different than what MBNA was doing? And then they're like, well, who's MBNA? And you're like, okay, so we have a communication gap here that we need to solve. Or an age gap, I suppose, that we can't solve. But I do think that the cyclical nature of it is really interesting. And even on like the top end of the market, right? So you have these programs, a bank is betting that like, okay, we're going to do 6 of these and maybe 1 or 2 of them will pop and will grow into something that's like meaningful and important to us. But the challenge is, and I'll just pick on Chime as the example here, although there's plenty of other ones. Chris Britt has said, we're going to become a bank. Like it's a matter of when, not if, and when that inevitably happens, and I would hazard a guess that it will happen in the next 18 to 24 months because you sort of want to hit the charter window before the charter window closes. Because again, these things are cyclical for various reasons. Like Stride and Bancorp will be pretty bummed out when that volume moves over because like you spend all your time and effort trying to cultivate a set of, potential winners. And then the hope is that you can hang on to them for a long time, but they'll migrate off. There's a graduation problem on the other end of it. And so the infrastructure is a persistently difficult area. And, I've spent, unfortunately, more time than I would like kind of digging into like the regulatory policy side of all of this. And I just don't see us ever really like coming up with a fundamentally different system for making it easier for new companies to get started at a very low scale.
Chime is such an interesting example because I often wonder, like, can there be a next Chime? Because I mean, like I worked with Chris at Green Dot and
sure.
He had a tough time getting started, right? Like he had a bold idea and it was hard for him to raise money. I think it's like very well documented now. They had a really hard time raising their second round.
Yep.
And like, will a bank take that chance? And to your point, like now it's a huge program. Like a bank should take that chance. So there is a bit of betting and like we're all going to miss some potentially amazing programs if the bar is too high. I'm also super fascinated that they said they're going to do a bank now because they were originally not going to. And I think that
famously,
I think about the world in 2 big buckets. And one is like the card is my primary product and the other is the card is an ancillary product. And so like if you're a Chime, the card is your primary product and owning your full stack, owning your processor, owning your bank gives you a lot of capabilities. I don't know. I still wouldn't want to be a bank personally, but like that's a choice that makes sense in many ways.
Yeah.
If you're, Robinhood or whatever, and your primary business is stock trading and your debit card is like a thing you do on the side, like it makes a lot less sense to own a bank. And maybe they still will. I don't know. But like, or, we talk about these vertical SaaS companies, like they're never going to want to own a bank. So I think that you're also going to see the issuers continue to shift who they're excited about to companies where they're part of a suite, because I think those are going to be longer term relationships where owning a bank is like never going to be on the roadmap of one of those companies, because it doesn't make any sense from a management perspective, from a cost perspective. Whereas for Chime, it makes a lot of sense. Same thing with their processors, right? Processors invest a lot in their partners, and then eventually, like I'm sure Galileo. So if I was very upset when Chime left, like that was a huge account, but like it's not surprising in the long run that they wanted to bring that in house.
No, it's really not. And I mean, it is really interesting because I think that's a good way of describing it. There was a strange kind of moment, and this goes to your point about Chime. Like, is it ever repeatable? Like Chime came out of such a strange sort of moment in time in a bunch of different ways that it does feel very difficult to repeat, right? Like I remember writing about this in 2020 and 2021 when, like, because of larger macro factors, just VC money was just getting dumped into fintech. And that was like the famous like Chime, like we're a software company, not a bank, because at that moment, valuations for software multiples, were just way higher than they were for banks. And I think that sort of convinced everyone like, oh, there's a huge, future in companies that are totally card centric and dependent on card revenue, but are just going to scale like software companies, and it's going to be this amazing business. And as the bank, we can just like kind of be the issuer behind the scenes and sort of ride their coattails into the future. When if you looked at it less from like a environmental, like what is everyone saying, how is everyone acting at this moment perspective, and looked at it more in terms of first principles, you would look at Chime and go, at some point they have to own all of this because they are in debit interchange business and they need to own as much of that as possible. And not only do they need to own as much of that as possible, but they need to maintain full like operational and product control over this core thing. Like this is central to who they are. Whereas to your point about like Robinhood, Robinhood, I think gains, comparatively less in trying to own the full stack because like bank accounts and cards are not central to what they do. And quite frankly, them being a bank and being fully inside the regulatory perimeter when Democrats are in control of the White House and Congress, probably not a great idea from a regulatory risk perspective. So, these companies are very different, but I do feel like there are these like exogenous environmental factors that in the moment you're like, this is the greatest idea ever. And like, of course, this is going to work. So it does feel like a lot of these things are sort of artifacts of the moment that they're born to a degree.
Very, very much so. If the charter window wasn't open, no one would be talking about owning a bank, right? Like they'd say
they'd be like owning a bank is stupid. Like, well, we want to be a software company. Yeah. But the opportunity exists, so they're taking it. I wanted to ask you about another category of products real quick, which is, and you've written a bunch about this, you've moderated panels about this, asset-backed cards. And I guess the setup here is a couple of things. One, obviously, in the world of credit risk, you can look at character, you can look at capacity, but a big one that you can also look at is collateral. I would say that of all of the C's of credit, collateral has been the one that's been the slowest to evolve or change or be innovated on top of. And I think a lot of that has to do with the fact that collateral is like an actual thing that has legal and sometimes physical characteristics that make it annoying to deal with, right? So like my dad, his first job right out of school was working for a credit union, and he worked in the auto lending department where they would go out and repossess cars, right? And so like he had a guy who was really good with a tow truck, and they would sneak into places before the person like woke up and like repossess their car. But like it was always such a like tangible and powerful example to me, because it's like, yeah, sure, the car collateralizes the loan. This is great. We can earn some of our money back. But the challenge is it's a physical vehicle that's sitting at someone's house, and that person might have a shotgun and they're in their house and they don't want you to take their car, like the value of the collateral on paper is very different than the value of the collateral in practice. And that applies to all kinds of different things, even if it's like a sort of thing that's more on paper, like stock values or whatever. Like, can I get access to the data that Fidelity has on this person's stock ownership, and can I title it differently so that I can get a lien against it in case someone defaults on the credit card that I'm giving them? So asset-backed cards, it feels like it took a lot of time and effort to sort of digitize the infrastructure around it so that collateral was easier to deal with. But fast forward to 2026, there's lots of examples of collateralized products or asset-backed products that now have a card attached to them. You've written about a lot of these. You know this space really well. Kind of walk us through what this space looks like and what the kind of premier examples of this working kind of look like.
Yeah, absolutely. I think it's really been the story of the last 5-6 years. And now we're reaching that kind of like maturity where you're really seeing these products enter more of the mainstream. Traditionally, with credit cards, you could, do cash secured cards. And the reason for that was to build credit, right? Because otherwise someone wouldn't be issued one, might be a $200 limit. It wasn't really about extending credit. It was much more about building credit. And the current batch of cards are much more about extending credit. So, 5 years ago or so, you had several companies start around the same time. You had Aven, which really leaned into home equity. You had Yendo, which does it for auto. They do home equity now as well, but that's where they started, was like secured against your car title.
Yeah.
And you had Pesto, which was doing it against like jewelry and like things you might otherwise pawn. Pesto has since pivoted to being a secured credit card program manager. And they're a company I do some work with. And the part of the problem they had was people were sending them fake stuff all the time. Like it was a very expensive process. And I think, but all these products represent, hey, you have some asset that you don't want to sell or that you're currently using, like your house or your car, and you need access to credit. Yeah. And we can help you get that. And simultaneously, these two other things are happening in the macro economy. One is interest rates for credit cards are very high, and they are higher than they quote unquote should be, right? They've gone up higher than the underlying rates over the last 10 years. We could argue about why, but it's just true. Sure. And the second is asset values have grown, right? From this low in the great financial crisis. So when you think about like stock, or Bitcoin secured products, like those are assets that you maybe don't want to sell and create a taxable event because you have a lot of value tied up in them, but you want to have some access to that. So now we have, Aven is doing Bitcoin and homes. Yendo is doing homes and cars. We have GoodLeap recently launched with a home card. There's Trovy, which has a home equity card. People are trying to build much stuff. I know there's some entrepreneurs trying to build these like stock ones, like you mentioned, where you can securitize any stock you have. And those really are lending. So it's like, I know I want to carry a balance, but maybe I can pay 10% instead of 30%, which is a huge benefit. They are complicated. Like if you get an Aven card on your home, it is a home equity line. Like you're putting a lien on your house. Yeah. You have to notarize things. It takes like, you get the 3-day rescission period. Like this is not as simple as signing up for a credit card.
No.
And there's problems on the asset side. Like, as you know, from your dad's story, like sometimes you show up to take the car and like they knew you were coming and they stripped out everything off of it. Said, oh, I don't know what happened. It's got no wheels. It's got no stereo. Right. So like the asset isn't always worth what you think it is. So I think I'm really into it because I think it's truly innovative. It's not just like new rewards. It's setting new and hard. I think it does provide access to capital in a more cost efficient way, but I think we're very far from it being mainstream. I mean, Aven, I think the guys at Mintel have this data, right? But I think Aven is like sending more direct mail than even Capital One some weeks right now, which is insane to think about. Yeah. But like, I don't think your average person knows or has one of these products. Like it's a thing. And home equity in general only exists because mortgage rates went up a whole bunch. Like there was no home equity lines of credit 5 years ago, right? There's no reason to have one. You just refied. It was fine. So there's all these other factors at play.
Yeah, I mean, one, and to your point, like it is a very sort of sensitive to macro conditions, kind of cyclical thing, right? I mean, it gets back to the 4 C's of credit, but like character and capacity tend to be things that sort of work countercyclically. Like if you're a good credit risk, you're a good credit risk, and we'll underwrite you for, a revolving credit line of, $25,000. The asset value stuff is trickier, and it does touch the real world in a very different way. The other thing that I'm kind of curious about there is, again, going back to this question of like segmentation and who you target, because it does feel like if you're just a sort of regular revolving credit card issuer, your calculation for how you want to balance sort of transactors, revolvers, kind of like the difference between those, it's a very different balance and mix that you're trying to sort of strike. If you're doing an asset-backed card, I would think that you want to be probably much more conservative in the lending that you're doing, because you are facing a lot more sort of severe downside on the other side of it, right? Like it is very unpleasant to actually like repossess someone's car or to initiate a foreclosure on a house. Like that is like worst case, expensive. It's really highly regulated. It takes a long time. You never get all the money back out that you want to get anyway. And so there's like this really unpleasant cliff on the other side of it that you want to try to stay away from as much as possible. And so my assumption would be, and I don't know this, but my assumption would be that the benefit of the asset-backed cards and the asset-backed products is more around what you were saying, where it's like, look, rates are higher than they should be. You're a relatively sophisticated like borrower, and doesn't necessarily mean that you have to be rich or have a high credit score, right? Like, Yendo's a good example with, car title loans. Like those tend to be a little more like near prime, subprime sometimes, but it's still like picking out a segment of users who are a little savvier. And I almost think about it more as like democratizing the capability that ultra wealthy households have had for a long time, where they never actually buy anything. They just sort of use their assets to borrow against it, and they just kind of move money around. Like this feels like democratizing that capability for people who think in a similar way, but haven't had the unlock from a wealth perspective to enable that type of wealth.
I'm going to disagree with you that these folks who are getting these cards are savvy. I don't think they are. Okay. I'm not clear I understand. I think there's a couple factors. Like one, for sure, no one wants to do the repossession, but they know they can. Two, there's a huge haircut involved, right? So like if you're, let's say you have a 680, right, and you carry a balance, but you own your home. You can go to Aven and you can get like $100,000 credit line if you've got $200,000 in equity in your house, which you very well might in today's economy, at 11, 12%. You can refinance your existing credit card debt. You can go buy the thing you want. And if things go south, they've probably only given you half of the available capacity, And similarly, like I know Yendo does this, like if your car's worth $10,000, they're going to give you like a $4,000 line. Like they're going to try to protect themselves.
They're careful,
And, I think people are just seeking money at that point. And I think you're right. It is democratizing. And that's where like people are trying to do this in the stock trading part. That those people probably are more sophisticated. Like if you have $1 million portfolio at Schwab, you can get a margin loan, right? And it's probably really inexpensive. And there's some risk to that, but now you can get a margin loan, but it's on a credit card. It's just, you swipe it. It's super easy. You don't want to sell those shares because of the tax implications. So I think there are some good aspects there, but I think you are seeing much higher credit limits than those individual borrowers would otherwise see. Like no one is getting a $100,000 credit line on their Chase Freedom, right? They're getting maybe 10,000. So,
and it's interesting. You make a good point that like the way to think about it maybe is it's sort of like presented as a win-win to both sides, right? Because from like Yendo's perspective or Aven's perspective, like, look, what we underwrote versus what we gave them is a fraction, and we're really protecting ourselves from a risk perspective. But from the end customer's perspective, they are getting approved for way more credit than they otherwise would by tapping into this asset. And so I think that does speak to kind of the appeal and the growth of this category. The flag that I would add to it is, and this is just a thing I keep kind of thinking about, and there's no real answer to it until the thing actually happens, but we've had such a long period of the credit cycle being sort of positive, right? And I know there have been little shocks and little things. Obviously, you mentioned private credit investors are a little skittish right now. We had the pandemic, which was this weird exogenous event, but like a sort of traditional recession dip in the credit cycle, whatever. Like there is a generation of now very, very large companies that are sort of building their risk models on a set of assumptions that may or may not be valid. And I am very 100%. Curious, particularly with this category where I'm like, okay, so like, like if I'm Aven or I'm Yendo or whatever, like, okay, I think that I have taken the precautions to only give them a fraction of what they're actually approved for. But like, if this goes bad, if these customers are thrown into severe sort of economic stress, am I protected enough? Like, am I really willing to go repossess a bunch of cars or houses or whatever? Like that to me is an untested assumption at the moment.
I agree. I mean, I think that's like a famous cautionary tale from the older folks around here, right? It's like, you ain't seen nothing yet. Like, who knows if your credit model works? And I think an interesting example of this is Aven's Bitcoin card, where the higher your LTV on the Bitcoin you pledge is, the higher your APR. And because it's crypto and they take custody of it via BitGo, they auto sell and auto margin call you, which like, because Bitcoin's so volatile, I think you have to do that. And I think that's a good example. But homes are very hard. I mean, yes, if we have another major recession and home values plummet, like Aven and Trevi and these guys are going to have a really hard time. There's no way around it. It's unclear. No one can predict the future. But yes, I agree. And even for just folks doing, cash flow underwriting for new credit cards and trying new things, like it's all very untested. Like the era of cash flow underwriting is mostly post, GFC, and it is really know how it's going to behave.
No, it's very, very true. Yeah, you talk to like the old grizzled like chief credit risk officers, the one who are like missing an eye and wearing an eye patch and like scarred and just sort of like limping around. Like they will say these things and we're all like, oh, it's going to be fine. But these things eventually come around. Matthew, before I let you go, mostly as a treat to you and I, because I think we've done a good job eating our vegetables. I want to talk about a product that I think you wrote about first. I wrote about, our friend Jason Mikula at Fintech Business Weekly wrote about Covered, which is, I guess the shorthand is like if you sort of cast a spell on a slot machine and turned it into a credit card, maybe is the way to describe it. It's basically it started out as like more of a kind of a like set of online lottery games, but it's becoming a credit card. The main thing that distinguishes it is that its reward structure sort of really leans all the way into kind of the variable reinforcement psychology, where sometimes, a transaction will earn you no rewards, and sometimes a transaction will pay itself off completely. The cashback can be taken out as cash, but it can also be applied to buy tokens to play their little sort of lottery mini games. Like it's very much, I think Jason in his newsletter called it like a late stage capitalism fever dream, which sounds sensationalistic, but
very appropriate.
I think so too. And like, if just go look at the website to sort of see what we're talking about. What are your impressions of this card? And I guess tying us back to the very beginning where we were talking about the culture of the people who build these products and what it sort of says about where we are in the industry. What would be your diagnosis about like anyone thinking that this is like an idea that makes sense? Like, what do you think this means for kind of product management in fintech at this moment?
Well, I think like you, I am not a fan of prediction markets and gambling.
No.
I think it's bad.
Yeah.
However, it's everywhere right now, right? Like, and many people, I think across the whole country, believe it's a good way to manage their finances that's also fun. Like maybe they'll get rich, and that represents the desperation I think a lot of people feel with their economic futures. So that's like super depressing. And I think Covered speaks to that, because it's like, well, you could earn 2% cash back for a really long time and then maybe do something, or like maybe you'll be lucky and get 34% cash back when you swipe your card at this particular merchant at this particular time.
Yeah.
there were two fascinating things about this to me. One was just like from a business perspective, like they launched without permission of Rain, who's their program manager. And I think we all heard about it right away.
I saw that.
And I felt really bad for Rain because like I've been in their shoes. Like you can't control your customers. Sometimes they just do stuff. So like we'll see what the final version looks like. Yeah. But I was really interested in like lottery savings products. Like we had Long Game and Yada and like using kind of gamification to reinforce good behaviors is really interesting. And I have spent many hours thinking about like, what would a sweepstakes card look like where it's like one user a month, you know, gets their whole balance paid off. And like, not that does that encourage spending or does it like reward people or, you know, can you earn entries by paying your bill on time or paying more than your minimum? This is just like gambling nonsense to me. And I hate it. Yeah. And, you know, like I think people will do dumb stuff to game it and they're like, people will complain. And like, I'm not saying these guys are like cooking the books or like whatever the equivalent of, you know, messing with a slot machine is, but it just sounds terrifying to me. And I hope people don't use those cards or apply for them. Plus it's like a secured card and a stable coin. And so it's just like a totally weird structure. But it's kind of the whole thing's just depressing. Like it's just like the fact that you can't watch a baseball game anymore without being, you know, like just clobbered with, you know, Kalshi ads. And I'm like, you know, what's going on here, right? Like it's just money being taken out of the pockets of people who are unsophisticated or desperate, and it's not good.
Yeah, that's you're channeling my feelings about it exactly. I mean, I think to add one thought to it, it is really interesting in terms of like the moment that we're in, because I think you articulated the demand side really good. Like, why would any consumer sign up for this? Well, it's because gambling is sort of pervasive in our culture right now. People are sort of economically desperate. They're looking for like long shot bets to try to get out of the situation that they're in, financial nihilism, all this kind of stuff. Yeah. The supply side is the part that I find sort of weird and disturbing, even more so because, you know, I was reading an interview or a profile that This Week in Fintech wrote about the founders of Covered. And they were saying the origin of the idea came from hearing about a product that they got pitched as like an angel investor. And it was kind of like the opposite, right? It was like a forced savings product that would like sort of lock down different categories of your budget and really help you like manage your spending. And when they were pitched that, they basically were like, no one wants that. We should build the opposite of that. And to me, like that is a very depressing instinct that I think seems to be sort of increasingly evident within like the current class of people building in fintech. And I don't necessarily even really fault them specifically, although I wish they would sort of reach for a slightly higher aspiration, because so much of like the building blocks and the infrastructure around them is just this, right? And like you mentioned the secured part of it, which is kind of hidden in the T's and C's, but like, why would you make this product something that has to be secured based on like crypto or stable coins? Like there's no real natural reason.
I think that's because it's the only program manager who said yes to you, is my guess.
Right. And so it's like the thing I kind of keep coming back to is like, if gambling and crypto and all these things end up not just as end products, but as like the infrastructure primitives for new 25-year-olds who want to build a fintech company, they're just going to start there. And they're going to be like, well, I could do this, or I could do this thing over here and it's sitting right there. Why wouldn't I do that? And like all of these things, gambling, speculation, sort of alternative, non-regulated, you know, payment and dollar rails, like all of these things seem like they are quickly evolving from end products where at least it's like, okay, I know that this is risky and I'm signing up for it and I kind of have my eyes wide open as a customer, to sort of like infrastructure primitives that are sort of infiltrating behind the scenes in products. And like, to me, that's a large shift that is going to be harder to undo or back away from, because a whole generation of people building these companies are just going to build with it as the default. Does that make sense?
Yeah, it does. And I think you're right. There's a lot of really interesting things that like using a platform like Rain unlocks. It doesn't have to be this, but it also could be this, I guess. So Yeah.
Yeah. It's kind of the difference between what you can do with it versus the culture of what you should do with it. And I do feel like it's worth continuing to talk about. Matthew, we've come to the end of our time, and you're a busy man, so I'm going to let you go. Thanks so much for coming back on the podcast, though. This was a ton of fun.
Yeah, always a pleasure. Thank you for having me.
Absolutely. We'll do it again. Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.